So there's many kinds of investing, right? People tell me, oh, I want to try options trading, oh, I want to do Forex, and so on and so on and so on. Today we're going to be talking about passive investing. So what exactly is passive investing? It's different from passive income. Passive investing, as the name implies, means you don't do anything and yet the money you invest continues to grow. In trading, you buy a particular thing or an asset, and when it goes up, you actively sell so that you make your profit. That's active. For example, trading stocks, trading currencies, trading options. These are all trading. But in passive investing, what we do is we just buy and hold. While this might seem similar to value investing, where you look for a good stock based on its fundamentals and then let it grow, passive investing really just means you buying the entire market versus one particular stock. What do I mean? So you know that the stock market is made up of many different stocks or companies. And some of these companies can be really expensive. For example, some of the technology companies out there, I won't name any, can cost anywhere between a few $100s to over $1,000 per share. And sometimes if you were to put in $1,000 into one particular stock and it tanks, you're going to lose all of that. It can be very risky. In passive investing, we try to buy the entire market or even the entire sector. For example, the S&P 500 is an index that tracks the performance of the biggest 500 stocks on the US stock exchange. So if you were to buy the S&P 500 index fund, you would enjoy the performance of all 500 stocks without actually buying all 500. You just have to buy the index. If you look back over the past 20 to 30 years, you'll know that the S&P 500 has actually increased over time. And so when it comes to passive investing, buying the entire S&P 500 makes more sense because you can't tell whether one of these stocks might do well, one of them might go down, and so on and so on. But instead, I know that over time, the S&P 500 will continue going up. That's one example of how you can use an index fund to do passive investing. Other examples of index funds could be funds that track the Dow Jones, the ones that track the S&P. It can even track a specific country like Singapore, Hong Kong, China, and so on and so on. It can even track a specific sector, like for example, it can track oil, it can track gold, it can even track the whole world's stock exchanges. With passive investing, you don't need to figure out when you should get in, when you should get out. There's really no worries. All you have to do, buy and hold on. We'll cover more about passive investing in our next videos. This has been Afik from Fuss Free Finance. Do let me know what you think in the comments below. I do this just for you.